So gold doesn't do narratives. All it really does is the quads, and what I mean by that is what it really loves is real rates. So the real 10-year yield at 0.15% this morning has not budged at all in 3 months. So think about all the FOMO we've had chasing equities. This just hopeful quad two recovery narrative that, or at least there's not called quad two in the mainstream media, but in terms of inflation and growth accelerating as an expectation, sort of the consensus expectation. Think about all that FOMO that's sort of been concentrated in the U.S. equity market. You haven't seen it at all in the bond market. Certainly not on a real yield basis. So real yields at 0.15% this morning. They've done nothing over the last 3 months. Flat, zilch, nada. They're actually down 2 basis points on a month-to-date basis. Meanwhile, nominal rates, which everyone's sort of hot and horny about, have actually accelerated 23 basis points over the past 3 months, up 12 basis points on a month-to-date basis to 1.9%. That's been driven entirely by inflation expectations. So when you decompose the real rates, term premium, and break-evens, and you look at what break-evens have actually done over the past 3 months, which is up the same degree as nominal rates, and then up 12 basis points as well month-to-date. You're seeing that the move in nominal rates has actually been just primarily and only driven really by the rise in inflation expectations. So there's been no change in growth expectations as it relates to the bond market, but there's obviously been a resurgence in inflation expectations that investors have had to risk manage alongside of bonds and bond proxies this quarter. We suspect a lot of that pain is in the rearview mirror going forward, just given the sort of pending quad 3 to quad 3 setup that we've talked about in recent months. So again, just going back to gold, if you don't see a breakout in growth, you're not going to see a breakout in real yields, and you're not going to see a breakdown in gold. You go back to November when every chartist in the world thought the gold was breaking down. Clearly not the case. You look at the question marks there on the screen. That's when the chartists were saying sell gold, the gold bull market is over. Clearly that's not the case as of this morning, because again, the bond market continues to sniff out what our models continue to point to, which is a ongoing deceleration in U.S. economic growth, not only in Q4, but also heading into the first half of 2020 as well. You look at something like, it's just going back to the first half of 2020. So the quad 4 to quad 3 transition and from Q3 to Q4 of this year perpetuated reflation, perpetuated breakout in bond yields, or not a breakout rather. Sorry, I want to be more specific with those terms. It perpetuated a resurgence in bond yields back up to, sort of testing the trend line several times on a nominal basis, but clearly real rates have not done anything. But then you look forward and say, what's a second consecutive quarter of quad 3 likely to do to something like gold, to something like real interest rates, something like the dollar? Historically speaking, when you sort of sequence, and this is, we're pulling this from our conditional factoring back test that we've been doing a lot of work on lately. When the U.S. economy transitions from quad 3 to quad 3, you tend to see the real 10-year rate has an expected value of minus 12%. So whatever that number is obviously down 12%. So imagine if real rates are 100 basis points, they'd be at 88 basis points at the end of that sequence. Gold tends its expected value as a positive 1.4% when you have this sort of quad 3 to quad 3 sequence. So what we're seeing today in the data and what we're seeing in the prices is sort of confirming that. But if you sort of really look at it and layer on what that means as it relates to what the Fed is doing, so the Fed is obviously expanding its balance sheet pretty aggressively, and we expect it to continue to do so at least heading into the first part of next year. When you look at the conditional factoring back tests associated with Fed easing, which I think are equally as important and equally relevant here heading into the next year, the real 10-year rate has an expected value of minus 28%. So you're taking that down to 72 basis points now, as opposed to sort of 88 basis points on a minus 12% expected value. Gold has an expected value of down or up 7.6%. In fact, that is one of the best conditional factoring setups for gold. So you have quad 3 to quad 3 plus Fed easing, and then obviously that tends to be really negative for the dollar. The sort of expected value for the dollar in quad 3 Fed easing scenarios, at least historically, has been minus 0.9%, one of the worst conditional factoring setups for the dollar as it relates to quad 3. And on the dollar specifically, the breakdown of the dollar, obviously we've been signaling that for quite a few weeks now. That's actually starting to develop an immediate term inverse correlation to the price of gold on a 30-day basis. That R is minus 0.72 rather. So again, you have a lot of things working on your side as it relates to being long gold here. The transition from quad 3 to quad 3, the Fed's balance sheet expansion, the dollar breakdown, the lack of a recovery in the U.S. economy, et cetera, et cetera. So again, we continue to like gold. Gold's bullish trend by more at the low end of the Keys risk range.